Amazon Q2 earnings recap. Stock plummets amid AI concerns. Here's the $1 trillion question. Why did Amazon stock tank after smashing earnings? Despite posting a stronger than expected Q2 with $167.7 billion in sales and $1.68 EPS, blowing past the $1.33 estimate, investors are spooked by murky profit guidance and Amazon's vague AI strategy. Shares plunged 7% in after-hours trading, a painful blow that raises serious questions about the tech giant's path forward. The numbers that shook Wall Street. While Amazon's Q2 performance looked stellar on paper, AWS revenue surged 17% to $30.87 billion. Subscription services grew 12%, and international sales jumped 16%. The real drama came from what's next. Wall Street was bracing for an operating income forecast between $19.41 billion and $20.5 billion in Q3, but Amazon's offered range, $15.5 billion to $20.5 billion, sent signals of caution. The elephants in the room? Where Main Street and AI collide. Amazon's AI bets are starting to worry investors, analysts declared after the earnings call. CEO Andy Jassy fielded tough questions about AWS's positioning in generative AI, a space dominated by Microsoft's OpenAI partnership and Google's Gemini. Jassy's unusually lengthy answers avoided specifics, sparking fiery debates. Does AWS's $30.87 billion revenue indicate strength, or is it merely on autopilot while competitors innovate faster? Most IT spending still happens on-premise, Jassy argued, defending AWS's long-term potential. But executing that vision requires solving two major pain points: power shortages at data centers and chip procurement delays. Kuiper versus Starlink. Satellite ambitions take center stage. Jassy also pitched Project Kuiper, the Amazon satellite internet venture, as a cost-effective rival to Elon Musk's Starlink. The CEO hinted at commercial beta launches later this year and positioned Kuiper as a price-competitive player with existing government and enterprise relationships. But let's get real. Can a late entrant really dethrone SpaceX in the broadband wars? Or does Kuiper's delayed progress already put it at a strategic disadvantage? The market's verdict? For now, uncertainty is the operative word. Tariff roulette. Who will pay the price? Tariffs loomed large during the call, with Jassy admitting it's unsure who'll absorb the costs long term. Amazon's customer base remains robust. Prime Day sales hit record highs, and the 4-day event drove unprecedented Prime signups. But as tariffs take effect in H2 2025, consumers might face lifestyle changes. Will prices spike, or will Amazon's 2 million sellers absorb the hit? The company's hedging continues, and analysts warn of second-half volatility. Tariffs appear overstated for now, Jeffries argued, but the cloud of uncertainty persists. AI investments, high hopes or hype? Amazon's doubling down on AI tools, from Alexa Plus's voice-enabled actions to boosters like Agent Core for custom AI agents. But analyst Stephen Ju of UBS warns the market's expectations are sky high. With $105 billion in capital expenditures planned this year, mostly for AI infrastructure, Amazon's most coiled. Stock status hinges on delivery. Two burning questions. One, will AWS's Anthropic partnership pay off in complex AI workloads? Two, can Amazon's Teruya approach to generative AI, read less aggressive than rivals, still yield breakthroughs? Controversy time. Is AWS falling behind? Here's the part most people miss. While AWS grew steadily, Jassie's lack of specifics on competing with Microsoft's Copilot left analysts underwhelmed. Shouldn't the CEO have thrown more punches? Critics ask. Reddit threads are already lighting up with theories. Is AWS consciously avoiding the generative AI arms race, or are they stockpiling resources for a counterattack? The answer could decide Amazon's fate in the AI age. Primer, where are we now? New to this drama? Let's recap. Amazon's core strengths remain in e-commerce dominance and AWS's cloud infrastructure. But as AI reshapes the tech landscape, the company faces 5, and this is where the debate gets sexy. Should Jassy have dared to be bolder with his vision, or is his conservative approach actually prudent? Share your take below. I'm all ears. Amazon cloud computing struggles. AWS margins dip, shares dive. The stunning setback in its cloud division has left investors and industry experts buzzing with questions about Amazon's future. Despite showing promising overall third-quarter sales forecasts that even edge past market estimates, Amazon's star cloud service, Amazon Web Services, AWS, has disappointed, dramatically falling short of the high expectations set by its rivals. After the official results were released, Amazon's shares tumbled by more than 7% in after-hours trading. A stark reversal considering the 1.7% gain during regular trading that had pushed the stock to $234.11. But here's where it gets controversial. The core driver behind much of Amazon's profits, AWS, has not only underperformed relative to the aggressive results announced by competitors like Alphabet and Microsoft, but has also shown troubling signs in its profit margins. AWS saw its profit margin contract to 32.9% in the second quarter, a significant decline from 39.5% in this year's first quarter and 35.5% in the comparable quarter a year ago. In fact, this margin is the lowest it has been since the final quarter of 2023. Even though AWS managed to grow its revenue by 17.5%, reaching $30.9 billion, and barely surpassing the expected $30.77 billion, this modest beat has been overshadowed by the impressive gains reported by Microsoft's Azure at 39% and Google Cloud's 32% growth. Investment professionals are not taking this lightly. Ken Mahoney, CEO of Mahoney Asset Management, remarked, AWS is their growth engine, and to see that drop in margin is dropping the stock. According to him, the market was eagerly anticipating a dramatic boost that could drive the stock to new heights, and the subpar performance of AWS has been a major letdown. Amazon projects its total net sales for the third quarter to fall between $174.0 billion and $179.5 billion, which is slightly above analysts' average estimate of $173.08 billion. However, the outlook for operating income is more cautious, with a forecast ranging from $15.5 billion to $20.5 billion. Compared to the expected $19.45 billion. This tempered guidance has only deepened investor concerns about the potential underperformance of its cloud operations. Both Microsoft and Alphabet have highlighted that while demand for cloud services remains exceptionally high, capacity constraints persist, limiting their ability to meet every surge in demand, even as they ramp up spending on additional data center capacity. This scenario puts Amazon in a tough spot, given that AWS, while it makes up a relatively small portion of overall revenue, is responsible for about 60% of Amazon's operating income. And this is the part most people miss. Despite investing billions in artificial intelligence infrastructure, a move meant to secure a leading edge in the evolving AI landscape, Amazon has yet to roll out a compelling AI model through AWS. Many analysts worry that this lag could leave Amazon trailing behind competitors who are already reaping the benefits of cutting-edge AI deployments. Dave Wagner, portfolio manager at Aptus Capital Advisors and a notable holder of Amazon shares, described the AWS numbers as alarming. He emphasized that Amazon's strategy has relied on operating leverage, where revenue was expected to outpace its cost increases, a key factor in growth that, according to Wagner, has not materialized as hoped. While AWS faces these headwinds, other tech giants are simultaneously unleashing massive capital expenditures. Amazon forecasts spending of around $31.4 billion in the second half alone, suggesting a full-year capex outlay of roughly $118 billion, which far exceeds analyst projections of about $100 billion. In comparison, Microsoft announced it would invest a record $30 billion in just this quarter, and Alphabet even lifted its full-year spending forecast by $10 billion to a total of $85 billion. On a more positive note for Amazon, the company's retail side continues to perform strongly. The online store recorded sales of $61.5 billion, a robust 11% increase, while its advertising segment surged 23% to reach $15.7 billion. These results have helped balance some of the negative sentiment surrounding AWS. Investors also continue to scrutinize the effects of tariff uncertainties on Amazon's core retail business. U.S. consumer spending in June showed a modest rise, and CEO Andy Jassy addressed these concerns in an analyst call, stating, "Through the first half of the year, we haven't yet seen diminishing demand nor prices meaningfully appreciating." He further explained that the diversity offered by over 2 million marketplace sellers, each with their own strategies for handling cost increases, has helped mitigate any obvious negative impact from tariffs. However, Jassy admitted the future remains uncertain, especially as tariffs, notably those imposed in previous years under President Donald Trump's policies, continue to create a volatile global trade environment. Trump had argued that these tariffs would help bolster U.S. manufacturing and restore jobs. Yet many in the industry remain divided on whether this approach is benefiting or hindering retail giants like Amazon. Analysts have long credited Amazon with maintaining its market leadership in e-commerce through its relentless focus on low prices, rapid delivery, and an expansive selection of products. The company has also been actively encouraging suppliers to ramp up inventories to ensure a steady supply and keep costs down. Despite these efforts, reports indicate that prices for Chinese-made goods available on Amazon are climbing more quickly than general inflation, adding yet another layer to the complex challenges the retailer faces. In addition, Amazon has been cutting jobs across several departments, including AWS, books, devices, and podcasting. From the first quarter of this year, the company shed approximately 14,000 employees, reducing its overall headcount to about 1.46 million, the first recorded decline since the beginning of 2024. So, what are your thoughts on this unfolding drama? Can Amazon overcome these strategic challenges in its cloud division and continue to dominate e-commerce? Or do you believe these issues signal a fundamental flaw in its approach? Share your views. Do you agree with the cautious outlook? Or do you see a way for Amazon to turn things around? The debate is far from over, and your perspective might just add a crucial dimension to the conversation. This comprehensive analysis draws on the reporting of Deborah Sophia in Bengaluru and insights from editor David Gregorio. It also acknowledges the background work of technology correspondent Greg Bensinger, whose experience spans esteemed outlets such as the New York Times, the Washington Post, the Wall Street Journal, and Bloomberg News.